Welcome, everybody. As we started thinking about towards the end of last year, a number of we're going through tax planning, working with clients. Oftentimes, we'll get engaged and work with a client very late in the year or even after the year end, and they think, gosh, have we missed our window of time to do some tax planning strategies? What can we do? So we thought this would be a good time. It's after the end of the year to talk about some opportunities that may still be out there for us, for you as manufacturers, even though year end has gone by. So we want to take this opportunity to spend a little bit of time giving you some ideas about what else is available. Some of it under the new tax law that passed in December of 2017. Some of these have actually been around for quite some time. And so there are opportunities that exist now and even the potential to go back. So we're going to talk about accounting method changes, some inventory considerations, retirement planning, and a number of other opportunities. As Stacy mentioned, please do submit questions along the way. If we have time, we will try to address those. If not, we will try to address those after the fact. If they're really specific, we may not be able to get down to the specifics without actually talking to you, so we'd always be happy for a conversation after that. But right now, I'm going to first turn it over to Carrie.
Thank you, Mike. So I'm going to touch on accounting methods and what those are and what opportunities business owners have to take advantage of the new tax law and do some real cool tax planning. So in December of 2017, the Tax Cuts and Jobs Act was passed into law. And as a result, certain taxpayers are able to change their method of accounting. And just to back up a little bit, for tax purposes, the method of accounting is how a taxpayer recognizes income and expenses. So your accounting method for financial statement purposes can be different from your accounting method for tax purposes. Eligible taxpayers to change their method of accounting under the new tax law are considered small businesses. And how the IRS defines a small business under the new tax law is a business with average annual gross receipts of less than $25 million over the previous 3 years. Also, a taxpayer can't be considered a tax shelter. And for the manufacturing industry, this usually isn't a big issue, but where you would need to be cautious is if you have passive investors in your company, because if over 35% of the ownership of the company is with passive investors, then you could run into a potential problem there. So under the old rules, businesses with over $1 million in gross receipts and with inventory had to be on what's called the accrual basis. And what that means is a company would recognize income when it's earned. So you would book a receivable and you would also include that in your income, and that would be your taxable income for the year. And then you would recognize expenses when they are incurred, so they have to match with the income. Under the new rules, if you fall under this $25 million in gross receipts rule and you're not a tax shelter, you can actually elect to be on the cash basis of accounting, even if you had inventory and you were previously on accrual basis, or if you were on accrual basis for your books, for your financial statements. So what that means is under the cash basis, you don't have to pay tax on income until you actually collect it from your customers, and you recognize expenses as they're paid. So it's not really a simple calculation, and it's a little different for every company. Sometimes it's actually more beneficial to be on accrual basis for tax purposes. So what we like to look at is the relationship between your receivables and your payables and any other accruals that you have, such as accrued expenses, accrued payroll, things like that.
Well, Carrie, if we could step back for just a second. Looks like we have a couple of questions. One of them is, can you clarify what happens if you hit 25 million in revenue in 1 year?
Sure. So even if you hit $25 million in revenue in a given year, you have to look at that 3-year period to figure out if your average annual gross receipts are actually over the $25 million mark. And then even beyond that, let's say your average annual gross receipts ends up being over that $25 million mark, then under the rules, you would have to switch back to accrual basis for tax purposes. However, that change you get to pick up over a number of years, so it's not going to all hit that tax year.
Okay, and so we get the benefit if we switch over to getting a big deduction in 1 year, which I'll give an example on in a minute. But if we have to go back the other way, we spread it out over a number of years, so we don't pick it all back up again.
Correct.
Okay. Can you also, another question that came in, what's a passive owner?
Sure. So there's many rules around whether an owner or an investor would be considered active or passive. So one clear way is, are they involved with the management of the company? Generally speaking, if an owner investor is actively involved in the management of the company, then they're going to be considered active. If they have a direct family member, such as a spouse or child, parent, grandparent, that's actively managing the company, then they would be considered active. Also, if they've been active within the past 5 years. So this is common for retired owners, where they retired, they have a 5-year period where they're still considered active for tax purposes. And then they also look at how much time you're spending in the company. So, it's going to be a little bit different for every owner investor, but generally speaking, that's what they look at.
Okay, thanks, Carrie, for sharing that. We wanted to also give a couple examples around what exactly does this mean to go cash basis. So I wanted to use a real life example of a client we had last year where they had about $440,000 of receivables and about $140,000 of accounts payable and accrued expenses. So what that meant, so clearly there was a $300,000 difference there. And we were able to reverse off those receivables effectively, as if, since they had earned it, but they hadn't collected it yet. So we switched them over to cash basis, and we're able to reverse out that additional revenue effectively. And then the same thing with the accounts payable. What really effectively happened is we were able to reduce income by about $300,000. And so that's that one pickup all at once that we get to enjoy that first year. And so it's a tremendous benefit to go there. But as Carrie mentioned, it's not something that is just straight, and every manufacturer will apply this way. We had other manufacturers where their collections are very good, very quick, and they manage their payables where their receivables and their payables are pretty darn close, and it doesn't make sense necessarily to make that switch. Another interesting conversation I had with a client actually yesterday, we switched him to cash basis last year, got a tremendous benefit out of it. And it was funny because he had to change his way of thinking at year end, because as Carrie mentioned, it's based on cash receipts as opposed to the receivables. So there's a little strategy around billing and when you're going to collect. The other thing is paying down those payables. And the more payables you are able to pay down, the sooner you can speed up that deduction, so to speak. So for example, I'll talk to clients about if they were going to make their payables run the first week in January, the second week in January, and the cash permits, if we speed that up to a December payment, now we're getting the benefit a whole year earlier. Keep in mind, this is all just deferral or timing. It's going to come at some point, but our plan is to always defer and see what planning we can go do down the road.
Another interesting thing you can actually do if you're accrual basis for tax purposes that most people don't know about, and actually isn't even a part of the new tax law change, is if you have prepaid expenses on your balance sheet, so you prepay your rent or insurance or similar expenses, you can actually make an election for tax purposes to take a deduction when those are paid, and you don't have to wait until, for book purposes, they would hit your income statement as an expense. And then just one other word of caution that we've noticed with some of our clients who switch to cash basis is make sure you warn your banker that this change is coming, because when they see the tax return, they're definitely going to have some questions with this one big time adjustment.
And that's a great point. It's not only if you're thinking about getting financing, if it's something you've already got lines of credit and you're providing tax returns and financial statements, it is something to have a conversation with, so that way they understand it. We've been talking to a number of bankers who are still are learning and understanding what is happening here, usually we're able to walk them through and they understand. But it's something that is good to have that conversation in advance so you don't surprise them and they get all worried about what's going on. They definitely understand, for example, equipment purchases and writing off equipment under bonus depreciation or 179. Everybody's got that down. But particularly for manufacturers, since this wasn't an opportunity to do before, it's definitely led to a little bit of surprise. I want to make sure that you're communicating with them.
Okay, now I'm going to turn it over to Mike to talk a little bit about inventory.
All right, so this is going to be a little bit more of a background on inventory. The last couple of years through the Volusia Manufacturers Association, I've spent time working with putting on some presentations about inventory, and there's still a lot of misunderstanding. And so I want to make sure that in general, we talk about what costs are included with inventory from a financial statement perspective, and then we'll lead through the tax, how that changes for tax purposes, and then what opportunities we might have. So inventory is an asset. It's a balance sheet item. It's taking your raw materials, and we're going from raw materials through production, and we're going to convert it into a finished good, something that we're going to sell ultimately. And that process usually goes from raw materials to work in process to finished goods. And along the way, we're improving this product. We're adding value to it. And there's costs that obviously go into it, raw materials being the obvious one, direct labor, and usually for a lot of manufacturers, they've got the direct labor down, they understand that, they get that really well, and the raw materials. For smaller manufacturers, and we'll get into a little bit about how we're seeing with the smaller manufacturers and some of these tax benefits, they'll stop at raw materials. Direct labor and overhead will usually just be expensed out as they're incurring it. But if you're doing financial statements for your bank under generally accepted accounting principles, you're also recording direct labor and overhead into that. So that's how it's traditionally accounted for. And there's a lot of different methodologies, which obviously is beyond the scope of a conversation today. But those overhead items, though, just to be clear, are indirect expenses. So for generally accepted accounting principles, those are those expenses that are indirectly involved with producing. That's your maintenance, that's your facilities, that's even getting down to insurance allocated to the portion of the facilities. It's your utilities, things like that, that you're allocating based on whatever methodology that you use. And then on top of that, you'll look at your inventory and you'll say, well, I've got a portion of this inventory that's still in my inventory, but it's obsolete or it's old. And from that obsolete and that old inventory, you may even record reserves and say, this is something that we know is not worth the value that's currently on our books, so we're going to reserve for it because it's just old, that style is out, whatever the case might be. From that hits your expense from a book standpoint, but for tax purposes, reserves are generally not deductible, or not generally, they're not deductible until you actually dispose of that inventory or sell it below cost. So that's sort of traditionally how we've accounted for inventory. Again, from the smaller manufacturers, a lot of times you'll see either raw materials and just direct labor capitalized or just raw materials purchases, and oftentimes everything runs through the income statement, and then once a year they'll update their inventory to what they actually have, so they have a year, a total true cost of goods sold of what that for their P&L to have an accurate statement, because the owners are very involved. They know, and cash is king. Cash ends up, they know if they're producing cash that they're profitable, and they know their products, and it's easier to get their hands around those things.
Mike, quick question. How can your overhead calculation impact your tax bill, and how often do you recommend that business owners look at their calculation of overhead?
Yeah, that's a good question. So when you're getting into overhead, you want to generally come up with some sort of rate that you're calculating on your overhead. So you're going to apply it somehow. And sometimes overhead gets looked at once a year. Sometimes it never gets looked at. They set a rate. One of the things to be careful on is that it depends on what your expenses are. So I would definitely generally look at my overhead calculations on a quarterly basis and update them, because you could be over capitalizing overhead into inventory. And I've seen that plenty of times, which means you're actually taking more expenses off your P&L and put it on your balance sheet. until you sell it, and thus making more profit, more income that you're going to pay tax on. We'll get into 263A, which is another piece of the tax side of things in a minute, but we do want to make sure that our overhead calculations are accurate and updated frequently, so you're not overcapitalizing, undercapitalizing. It does get into sort of the matching principle from a financial statement standpoint. It can get a little bit complicated, but sometimes it can get overcomplicated, and we want to avoid that as well. So that way it's something that the accounting systems can actually handle. So I'll talk about a little bit more on the tax side in a minute, on the 263A side, but the starting point is that overhead calculation on these indirect costs, and we do want to make sure they're accurate and updated. One of the other things, and this is one of the lesser known, I just mentioned about inventory reserves, and reserving for that inventory that might be obsolete, might be out of style, might be damaged, whatever the case might be. You might just have too much of it and can't sell it. So you set those reserves, and as I mentioned, those reserves are often not deductible. Most people go from the standpoint of saying, well, I've got to get rid of any inventory I'm going to get rid of. I got to do it by year end. And that's generally true. However, there is a little known rule out there that if you do have damaged inventory, it's non-saleable, and you're no way of being able to sell it, but you don't get rid of it until, say, a couple weeks after year end because you're still doing your inventory counts, we can still deduct that as of 12/31. So it's a very little used rule because you don't see that very often, but it is allowed. It is something that we can do. So if you still have the opportunity to take a look at your inventory right now, we're still in January, and if any of it was damaged and you just need to get rid of it and take the deduction. So that way you speed that up instead of holding on that inventory. One of the other problems with inventory is the hidden cost of inventory. And so when you're holding damaged inventory, somebody's probably counting it, or if it's obsolete, somebody's probably counting it. Somebody's moving it to make space. It's taking up space in a warehouse that might otherwise be used. I've even seen many examples where manufacturers open up whole new warehouses to hold more inventory because they're not managing their inventory. So there's all these hidden costs of inventory. So I'm a big proponent of really going through, and you can often tell because it's the inventory, that the boxes that have all the dust on it that hasn't been touched, or you can see dust spots as you move something, for sure that might be the inventory. And of course, usually what I end up hearing is, well, I had something and I had it for 5 years and somebody actually needed it. Well, I get that, but think about over 5 years, how many times somebody has touched that, moved it, the warehousing costs, all the holding costs of inventory. So I don't know that after a few years of holding it, you actually got any profit on it from that standpoint. It probably cost you more money than it was worth. So, but that is something. And another scenario, and again, very, very little used, but if you have take an example of if you work in something that has, say, styles or specific specifications and it's no longer being used, within 30 days, if you mark that down, you can actually mark that down, take that deduction for it, as long as within 30 days you sell it at that reduced price. There needs to be a connection between the two, and it needs to happen really quick after year end. So if you have a situation where you did sell something much below what its cost was, you can also take that deduction as well. So there are some opportunities right now to take a look at damaged inventory or obsolete inventory and see if there's some opportunities. There are, like I said, there are some specific rules that you have to follow so that you can make sure you've got the supporting documentation and you follow the right processes to make sure that happens. But it is something that you can still take a look at. All right, so I mentioned this rule about 263A. And this is just the term that we use in the accounting industry because that's what the IRS calls it. And so we do this calculation. And so, as I mentioned before, from a true book standpoint, if you really want to measure your actual cost of goods sold, your gross margins, you do need to be capitalizing your raw material costs, your direct labor, and your overhead. And as I mentioned, that overhead is those indirect costs directly attributable to converting a raw material into a finished good. Now, the IRS says, well, there's more overhead than that. and really what we refer to it as additional overhead or effectively administrative costs. And so there's when we do your financial statements, let's just say, and we've got that initial calculation of overhead, then we do another calculation that looks at your administrative costs. For example, we might have your purchasing department, we might have some of your facilities that house your purchasing people, a little bit more insurance. We've got your HR people as they deal with your employees. So there's a whole calculation that we go through, and then we add, and so that means we take expenses out of your P&L and we add it to your tax inventory balance. So you can almost think of this like a separate set of books. So we're adding on all these additional costs that the IRS tells us that we have to through 263A. And so as your inventory goes up, that 263A calculation tends to add more costs each year. So you're kind of picking up a little bit more income almost every single year. If your inventory goes down, then obviously the opposite happens. And 263A, just as a ballpark, this number is all over the place, but you can look at it somewhere between 5 and 7% of your inventory are what we're adding to the costs every single year. And so when the tax law in 2017 came out, they said, okay, if you're under this 25 million, this magical number, you don't have to calculate 263A anymore. In fact, you can write it all off. And so this was a very obvious, this was a no-brainer. Get rid of 263A. So, we have clients who had, anywhere from $20,000 to $100,000 or more of 263A costs on their balance sheet, and we were able to file a change in accounting principle and basically write off all of that 263A costs in 1 year. So we were able to pick up an additional deduction all at once to for that additional overhead. And on top of that, obviously not calculate anymore. So it's something that just could completely go away if you were under the $25 million. It's a great rule. It's something that you can tell if it applies by looking at your tax return and seeing what's been calculated on it, and if that 263A is still there or not. But if you're over 25 million, unfortunately, you don't get the benefit of some of these rules. There's some other rules that we'll talk about a little bit later that still apply, but really the biggest bang was for those who were $25 million and under 25 million on average. All right, so here's where the wild west of inventory came in, and we use that because as we were trying to understand, we almost didn't believe it ourselves. And last year we spent a significant amount of time not only double, triple, and quadruple checking, but talking to experts who are actually talking to people in Washington to make sure that we were astounded. And so really what the regulations require is that you use the principle that best shows your net income. So if you have inventory, the method that best proves what your net income is by accounting for your inventory. So that means you put inventory on your books, you calculate overhead, this 263A, and that's the best calculation. Well, they came out with a whole new rule that said if you're under 25 million, so again, we're hitting this $25 million. So, well, you got effectively two different ways that you can, or three different ways that you can handle inventory. One is like you always have. In fact, if you want to, you can still even calculate 263A. Not sure why you'd want to if you're under 25 million, but you can. So you can do it the way you always have. The second is you can write off inventory. So that inventory you had on your books, you can write it off and expense it immediately, and through two different methods. One was anything under $2,500 was considered de minimis, and you could just write it off. Think about it this way: as you purchase those goods, rather than purchases hitting inventory, it would go right to cost of goods sold. Okay. Now some people are doing that anyway, but then they would true up their inventory every year. This means there's no true up of inventory anymore. It's just going straight through. You're not calculating direct labor. You're not calculating overhead. We are not doing 263 anymore. So that de minimis was one way. So anything under 2,500, it just considered that. The other piece is however you account for it on your books and records, which is where the wild, wild west came in, because they gave no definition really of what that meant, other than saying if your methodology was to write off inventory as you received it, so raw materials and all that, you could take that deduction for tax purposes immediately. You are no longer having that. We had some pretty tremendous success. Actually, in a second, Carrie's going to share an example. But so, what we had to do was, again, talk to clients and say, okay, because there's a lot of considerations that you have to go through here. This is going accrual to cash, as Carrie talked about earlier, is very simple because we can use accrual for book purposes and cash basis for tax purposes. It's kind of like keeping two separate sets of book. The downside with this is you cannot have a separate methodology for your books. You actually have to do this on your books. And so what are the ramifications of that? Well, it may be more difficult to tell what your gross margins are on a month-to-month basis as you're looking at your financial statements. There are ways around it. We're able to still handle that and calculate that and look at that. The other thing is if you've got to do GAAP basis financial statements for the bank or any other stakeholders, you really can't use this methodology without taking a GAAP exception. So when I say GAAP, again, that's generally accepted accounting principles. So if you've got to do a set of financial statements in accordance with GAAP, you really can't use this method. So this method is definitely not for everybody. And if your bank is looking at it, again, we don't want to surprise anybody with all of a sudden, because we can take, in the year we change this methodology, we can deduct all that inventory that's on your books in 1 year. And so that could create substantially lower income or substantial losses depending on how much that inventory is. And in fact, I'll let Carrie share an example with a client that we had last year.
Yeah, so we had a really interesting example of a client who's a manufacturer, has a lot of inventory, but they don't have to produce those GAAP financial statements for a bank. And actually, years and years and years ago, when they first came on as a client, they weren't capitalizing inventory. And we said, hey, under the tax rules, you have to be capitalizing your inventory. So when we read these new rules and we're thinking about which clients they could really benefit, we're like, hey, they didn't want to capitalize inventory years and years ago, so they actually might be a really good one. So when we were thinking, about, okay, should we use the $2,500 rule or should we just use the book rule? For them, it made less sense to use the $2,500 rule because the $2,500 only applied to anything purchased starting in 2018. So any old inventory that was still on the books from before 2018 would remain on your balance sheet until you actually sold it. But if on your books you wrote off all that inventory, then we could use the book method. So we were actually able to help them deduct over $2.8 million worth of inventory on their tax return last year, which resulted in well over $800,000 in tax savings. So it was a really exciting year for that owner, to say the least, and for us, because we got to assist them in doing that.
Well, what was really interesting about this is many of these companies use the opportunity, these tax deductions, to invest back into the companies. They were able to purchase more equipment this year. Some of them, I've got a client that we turned over to cash basis, and when the owner saw just how substantial the deduction was in that 1 year, they paid out substantial bonuses to every employee in the company. So it was actually a pretty neat thing to be part of, just to see the opportunities that got generated on it. But
another interesting caveat to this specific story, this specific example, is that this taxpayer, even though they wrote off all this inventory, they remained on the accrual basis because it made more sense for them. Their payables were much higher than their receivables in any given year. So if you think about it, they are getting a tax deduction for inventory that they haven't actually paid for yet. So it's actually really interesting under the new tax rules what you can do with businesses. But a common question that we were getting was, well, what happens if I want to sell my business in a few years and I don't have inventory on my financial statements? So Mike, how do you think that could impact a business owner?
Yeah, that's one of those considerations that we definitely need to look at, because if you're a couple of years out, it probably doesn't necessarily make sense to even go down this road, because it may just confuse the matter. But let's just say it happens, we do this, and years down the road you decide to sell. But when we start looking at getting into when you go through a process of selling a business, you're looking at EBITDA, so that's your earnings before income, taxes, depreciation, amortization. And in a selling process and a buying process, you look at what's called adjusted EBITDA. So we would go back and adjust to show what the financial statements would look like if inventory had been accounted for under generally accepted accounting principles. So it's not the end of the world if you're doing this, because you're speeding up. You're getting tax deductions now. Similar to accrual to cash, this is just a deferral. Matt, this is just pushing it down the road, the can down the road a little bit. It's getting your money now and not waiting for it down the road. So it is still a tremendous opportunity, but we really have to look at it from your unique situation. We had a number of clients who wanted to do this because it made sense for them, and other clients it just didn't make sense because of their particular circumstances. So it's something, if you're considering this, if this is something that can apply to you, it's something we'd want to have a conversation with you to make sure it does truly make sense for you. All right, with that, we're going to change gears a little bit. We've been talking about, so the accrual to cash opportunity, 263A, and then inventory are some tremendous opportunities for manufacturers. But now we're going to switch gears a little bit and get into some other standard stuff that are still available.
Yeah, so even if you're over $25 million in those average annual gross receipts, this is when you can start listening again, because these would apply to you and your company. You know, kind of a simple question you could ask is, should you be making retirement contributions? So, and there's some interesting differences in deadlines for retirement contributions based on what you're doing. So a little known rule is with pension plan accruals, if you extend your tax return, so for the business tax return, you would, instead of filing by March 15th, you would extend to September 15th, and you would actually have until September 15th to fund that pension accrual, even if you end up filing your tax return sometime between March and September. So that's kind of an interesting way to, get a deduction and manage your cash flows. You can also do what's called a SEP contribution. And the deadline for that is by the time that you file your tax return. So even if you extend your tax return, you have to make the contribution before you file it. You can do an IRA contribution, and that would need to be done at the earlier of your tax filing or by April 15th. So before April 15th, or if you extend by April 15th. Same with health savings account contributions. You would have to do that by the earlier of your tax return filing or by April 15th. And so I'm going to go into a little bit of what these plans are and their benefits. So a SEP plan, owners of either S corporations or partnerships or sole proprietors are able to contribute up to, for an S corporation, up to 25% of what you pay yourself in wages, or $56,000, whichever is a lower number. And of course, if you're over 50, you have a $6,000 catch up for the year. If you're a sole proprietor or an owner in a partnership, that calculation is just a little different at 20% of your net income, but still you have that cap of $56,000 plus the additional $6,000 if you are over 50. The other little catch with these plans is if you have other employees in your company, then the plan has to be available to them. So you can't just make contributions for yourself. So I also wanted to talk a little bit about contribution limits for 2019. So for a traditional, so there's different types of IRAs. There's a traditional IRA, there's a Roth IRA, and then there's ways that you can contribute to those a little differently. So with a traditional IRA, the way that works is you typically get a deduction, a tax deduction for your contribution when you make it. And then later on down the road, whenever you start pulling that money out of the account, you pick that up as taxable income. With a Roth IRA, it's kind of the opposite, where You do not get a tax deduction for it when you make the contribution, but later on down the road, when you take the money out of your account, you don't pay any income tax on that. And so you don't pay income tax on the growth in the account either. So, there's pros and cons to both of those types of accounts. And then, so as you can see on this chart, the contribution limits for both traditional and Roth IRAs is $6,000 for 2019. And then if you're over 50, there's $1,000 that you can contribute in addition to that. And there's certain limits based on income and whether or not you're covered by a plan through your employer, or if your spouse is covered by a plan for their employer. And so that's where we get into, if you are over a certain income threshold based on these limitations, you could still make a contribution to a retirement plan. You just may not be able to get that deduction. So for example, you could still make a $6,000 contribution to a traditional IRA, but you're not going to get a tax deduction currently. But however, what happens is you file a special form, and over time we calculate what's called your basis. And so for example, in 2019, if you made that $6,000 contribution and you did not get a deduction, then your basis in your IRA would be $6,000. And later down the line, whenever you start pulling money out of the account, not all of that is going to be taxable income to you, because you never got the benefit of taking the deduction when you made that contribution. And then some other things that you can do with that is, if you do make that traditional non-deductible contribution, you can actually roll that into a Roth IRA, and that's kind of a common way for higher net worth individuals to be able to still make Roth IRA contributions. Some people call that a backdoor Roth, if you've ever heard of that terminology. So moving on to health savings accounts. I love health savings accounts. It's one of my favorite things to talk to people about, because it's really the best, in my opinion, between a traditional IRA, Roth IRA, or a health savings account. It's really the best option if you're trying to choose one of those. Now, you have to be eligible for a health savings account, meaning you have to have a high deductible health plan to actually even be able to open one. But if you do qualify, then once you get to a certain level of contributions and certain balance in your account, which is typically relatively low, it's only a few $1,000s, you can actually start investing those funds just like any other retirement account. And so what happens is the contribution you make to that account in the current year is a deduction for you. And then those funds grow over time because you've invested them. And then as long as you use those funds for qualified medical expenses, all of that growth is completely tax-free. So, and there's no limit like an IRA account where you have to be a certain age to start pulling it out. You can use those funds for qualified medical expenses throughout your life. So I just think it's a really great way to get a tax deduction and a tax benefit and still be able to use those funds, because everybody's going to have medical expenses throughout their life. And we put in here just the annual limits for contributions for 2019 and 2020 as you're thinking about that. But just remember that it's not too late to make those contributions if you qualify. You just have until either April 15th or when you file your tax return, whichever is earlier. And you may have heard about the Secure Act that passed fairly recently. So we just wanted to give you guys some updates in terms of that. Required minimum distributions. So those are used to be required whenever you turn 70 and a half. And what that means is basically you had to start pulling money out of your retirement accounts, regardless of whether you wanted to or not. So what happened was, under the new rules, you're now not required to make those RMDs until you're 72. And there's a certain cutoff. So if you turned 70 and a half in 2019, then you're still under the old rules. And if you turn 70 and a half after, then you're under the new rules. So be thinking about that if you're kind of on that cutoff. But another major change was that there's now no limit on age for making IRA contributions. So, and a lot of this came out of the fact that a lot of retired people are still working on a part-time basis or just working longer. So now if you don't need to take those RMDs, but you're required to, you could actually reinvest back into your IRA, or reduce your RMD altogether. So another interesting thing is that part-time workers are eligible for 401k contributions. And of course, again, this came out of people working part-time even when they're retired. So those were the major highlights, but if you have any other questions whenever you're reading through articles about the Secure Act, we're more than happy to help you there.
All right, an oldie but a goodie. R&D, research and development. It's also been called R&E, research and experimentation. For manufacturers, this is just a tremendous opportunity. It actually applies in many, many more situations than most people even understand. Over the years, we've had a large number of manufacturers that were able to take advantage of it that never knew. Going back to a BMA meeting we had many years ago, we had a small manufacturer who was in the plastics area and was doing all sorts of really prototyping and developing, and before you knew it, really ended up realizing that through these conversations, he actually did R&D and was able to get a credit of a few $1,000s a year. The great thing about a credit is it's a exact reduction of tax. So if you got a $5,000 tax credit and your tax bill is $10,000, you can reduce that tax bill down to $5,000. It's a great thing. But what a lot of manufacturers don't realize is all the things that it applies to. And it's really one of those things that was intended to reward manufacturers or companies for increasing their activities around this experimentation, this research that they were doing. So as you can see on the screen, things like improving a product, second generation products, innovations for new equipment, new products, designing new processes or fixing processes to some degree, increasing manufacturing and production capabilities, prototyping. That's actually a really big one. And so, these are things that you are probably doing and may not realize that you've got customer specs that you've got to try to figure out, can we make this? How do we make it? And you're going through this process of, you've got labor, you've got materials, you're sending maybe designs over and then a prototype, and you're doing R&D. That's something. It could be process design, things of that nature. So this is an area that, like I said, is underutilized, and there is a test. So as part of this, it's first identifying a project. So there's a lot of documentation that can go into this, but it's identifying the project. What's the nature of the project? Is it for a qualified purpose? And we talk about qualified purposes, it's improving a product or a process, increasing reliability, quality, something like that. So you document those things. It's got to be technological in nature. So there's some sort of science involved, engineering process involved with creating this new process or this software even, or this product. A process of experimentation. In other words, there's the potential that for failure effectively. What you're trying to do through the technical uncertainty is eliminate the uncertainty, but there's this process of it could fail. You may not be able to get it there, and that's where the R&D comes in to that degree. And normally, and this is just an average, but if let's just say you had $100,000 of identified R&D expenses, it turns into about a 6% credit on average. So about $6,000. So you can see it does take a little bit of, it does take some dollars to get up to, but for some people, meaningful is $2,000 and beyond. Every company's got their own level of what's meaningful. Because there is a documentation process. You do need to go through and document these things. And as you can see on here, we can capture the wages directly involved in the R&D process, supplies, contract research, things like that are all applicable, but you do need to be able to tie it in. Now, a lot of smaller companies don't have payroll records that say I worked on this project and this project and this project. So you get oral testimony, or in other words, documentation of this is what I worked on and this is how long I spent on it and those kind of things, and that generally applies.
Mike, can you clarify what the difference and benefits are between a credit and a deduction?
Okay, so yeah, that's a good question. So let's just say you never did any R&D calculations or anything, you're just incurring these expenses, you're going to get a deduction for it. So if you've got $100,000 in wages, as an example, related to R&D, you'll get a deduction. So that's a $100,000 deduction, which will save you taxes ultimately, but it's not a direct reduction of those taxes. So a deduction is just reducing your income, and your income goes down by whatever the dollar amounts are. Whereas a credit is literally reducing the actual tax number. So which is why we take a look at this and say, yes, you've got these deductions, you've got these expenses, let's turn it into an actual credit because it's much more worth than the deduction for it. So the key thing here, though, is the documentation identifying these things. I do believe, and it's something worth talking about. It is complicated, but a lot of manufacturers are applying for it. And here's the nice thing: we can go back and look at last year still and determine, do you have R&D expenses that qualify? In fact, we can go back a couple of years, perhaps even 3 years, depending on certain situations. So we may, you can, this is what I said by an oldie but a goodie. This thing's been around, and if you were doing it in previous years, this is something that you can actually go back. For some companies, that's worth it. Others, it's not. But without having a conversation, it would be tough to say.
All right, so I'm going to touch on just some other opportunities that are available as well. So kind of to circle around back to accrual basis. So if you decide that, accrual basis really makes more sense for me from a tax standpoint, or if you're over that $25 million threshold and you still have to be on accrual basis, make sure you're looking at your year-end cutoff items. So for example, did you have any receivables that are uncollectible, you're not going to pursue any longer, and those really should be written off as bad debt? Were all expenses that were incurred in the tax year actually accrued? So a good example for that is like real estate taxes. So if you didn't pay your current real estate taxes within the tax year, did you go ahead and accrue those? So you're not missing out on any potential deductions. Another big one was the qualified business income deduction, which outside of accounting method changes, I think was probably one of the biggest tax planning opportunities under the Tax Cuts and Jobs Act, and it really affected most small business taxpayers. If you're a pass-through entity, meaning you're a sole proprietor or a partnership or an S corporation, this was available to your company potentially. So, and what it is it's a 20% deduction of your qualified business income. So for a manufacturer, it's really a no-brainer. Your income is qualified business income under the rules. So potentially 20% of the net income that flows through to you to your tax return could be excluded from being taxed. So if you think about it, you would only be taxed on 80% of your net income, not 100% of your net income like you have in the past. However, if over certain income thresholds, there's limitations involved. And one of those limitations is wages. So your deduction is limited to 50% of the wages that your company is paying. Another limitation is depreciable assets. For most manufacturers, though, it really comes down to the wages because it's such a capital intensive, or it's such a labor intensive industry. So something that we're looking at with a lot of our business owners is actually, do you have unreasonably high compensation for yourself? Should you actually look at maybe paying yourself a lower wage and taking more of a distribution? Of course, you have to pay yourself something in an S corporation, and it has to be considered reasonable. But what we found is actually a lot of owners are paying themselves too much, and it's actually increasing their tax bill because under this rule, if you're paying yourself a wage, then you're reducing that income that's eligible for this 20% deduction. Whereas if you paid yourself a distribution, that would not be limiting that deduction. And then something else we're also looking at is charitable contributions. In 2018, the way that the regulations were written, charitable contributions weren't really an issue, but the IRS came out with a new form for 2019 and is actually including charitable contributions paid by a business in this calculation. So, for example, if you make if you're a very generous business owner and you like to make big charitable contributions through your company, that's actually going to reduce this qualified business income deduction for you. However, the difference is if you took the cash out of the company as a distribution and personally made that contribution to a charity, it would not be included in the calculation. And it's not going to change how that charitable contribution is reported on your personal tax return. It just changes this calculation of this deduction. So right now we're looking at, okay, really, was that a personal contribution or was that really from the company? And we need to make sure it's reported properly so that you're maximizing this deduction. And then lastly, for our manufacturers, we want to make sure that you're not paying sales tax on any manufacturing equipment that you've purchased throughout the year. And if you have, we can help you to go back and get a refund on that.
And along those lines, there's also sales tax exemptions for utilities, electricity on the production side of the plant as well. So it's something you can contact your utility provider. One other thing to note, the 20% deduction that's there now, the qualified business income deduction for manufacturers, this used to be, this sort of took over for the manufacturer's deduction, which the last few years has been about 9%. We have seen a number of instances where that deduction actually wasn't taken for manufacturers. So it is something to take a look on your tax return to make sure it was there, because again, we have seen it missed on a number of situations. Real quick, as we're running down on the last few minutes, cost segregation. So this is if you've purchased an existing a facility, or even if you built one or have substantial renovations, it's something where you can actually take components of this build out, this existing facility or renovations, and segregate them into different depreciable classes. Generally speaking, when somebody builds a building, they throw it all into one big lump called building, and they depreciate over 39 years. Under a cost segregation study, we have experts who are basically engineers who go in and help out determine the appropriate classifications. You can think in a manufacturing environment, such as, we use a simple example of a concrete floor that you have to build up significantly more because you need extra, because you got heavy equipment on there. It could be other things like specialized refrigerate, other things going specialized into it. There's a number of classifications that go into it that we'd want to be looking at. And what you do is you can actually depreciate it faster. A faster depreciation gets you a bigger deduction now as opposed to later on down the road. One of the other things to be careful on as well is, as we've seen it over the years, where let's just say you replace a portion of your roof or replace your roof. Well, we got to make sure we also dispose of the old roof. There's a calculation that can go into disposing that and making sure, because again, oftentimes that hasn't been fully deducted for tax purposes, and it's something we'd want to look at. So there's a number of things around fixed assets and these improvements, these buildings, that you have some opportunities to take a look at and possibly depreciate faster.
And then the last thing we wanted to touch on today was tangible personal property returns. I'm sure all of you have probably gotten your letters from the county already that they're looking for one for this year. So you're probably aware of this, but if not, the filing deadline is April 1st for the coming year. So 2020 returns are due April 1st, and it's based on the assets that you had as of the first of the year. So really the important thing to know is make sure you're reviewing your tangible property for, are there any items that you don't have anymore that are still listed there that you need to remove on your tax return? Do you have any items on there that really shouldn't be on there? For example, software or vehicles. If you pay, a tag on a vehicle, they're not going to then hit you for tangible property tax on it as well. And then also the condition of those items. So the county takes all of this into account when they're determining what they're going to charge you for your personal property tax. So they're going to assume, if you don't put the condition on there, that it's good. And so that's how they're going to value your equipment. Whereas you might have very old equipment that's really not in good condition anymore. And if you indicate that, then the value of that equipment will be reduced on the county's end. Just another quick thing to note, there is an exemption of $25,000. So when you file your first tangible return, if you're a new business, If the value of your equipment is less than $25,000, then you will not be required to continue filing tangible tax returns until the value of your items get above that $25,000 threshold. If you have new locations for the year, you're going to have to file tangible property returns for each location that you have. So keep that in mind if you're expanding.
Actually, one last thing before we go, there is a, if you export, in other words, you sell overseas, and you have a substantial amount of those sales, this is somewhat complicated to get into in a 1 minute, 2 minute time frame. We do have a couple questions we want to answer real quick, but it's effectively you set up a paper entity, and it's just, again, all on paper, and you're able to pay a commission, get a deduction at your tax rate, and then it pays basically a dividend back that you get at a much lower rate. So it's effectively reducing your income. It's the only tax incentive really out there for exports. So it is something that is available. We do use it on a couple of clients, and it has been worth it. But again, it's a complicated process to set up, and you need typically substantial amount, usually, excess of $1 million or so in exports before it becomes probably worth it in a lot of cases. But it is something, if you are exporting, it is something to take a look at. That said, we do have a couple of quick questions that I think we can get answered before we end here. One of them, Carrie, is on the qualified business income deduction. What happens if you're a C Corp?
So C corporations are not eligible for the qualified business income deduction, and a lot of that came from, they actually got a reduced tax rate down to 21% under the Tax Cuts and Jobs Act. And so this deduction was really created to try to equalize the playing field between pass-through entities and the C corporation, except for, of course, there's a lot more administrative costs that go into this qualified business income deduction than just reducing a tax rate. So,
well, and this has come up quite a bit. Companies, should they consider, or should they switch to a C Corp given that 21% tax rate you just mentioned?
Right, and so there's a lot of considerations when we look at that. Not every company's going to have the same answer. So we really have to look at what is the long-term plan with the company, what's happening in terms of cash flow with the company. Are you leaving cash in? Are you wanting to take it out? Where is the company located? In Florida, we don't have income tax on individuals, but Florida does impose an income tax on C corporations, and most people don't realize that. So they see 21% and they're thinking, oh, that sounds great. I'm in the 37% bracket personally. But then you have to add on 5.5% of Florida income tax, and there's double taxation with C corporations. So when you take cash out of the company, it's like you're getting a dividend from stock you own, where you're picking up that dividend income at your 37% income rate.
Well, we see it on companies that are C Corp looking to sell. They sell their assets. They pay tax at 21%, and then when the owner who sold all those assets takes the money out of the company, now you get another 20% plus, so the tax does end up adding up. So there's a tremendous amount of considerations, as Carrie mentioned, and there's not just one straight answer for each company. So with that, I know we're 2 minutes past. Thank you, everybody, for participating today. As Stacy said early on, we will send out the slides. And of course, if there's any questions beyond what we were able to get through today, here's our contact information. We're always happy to take a phone call. You can visit our website. We actually, on our website, we have a number of these topics today are covered in articles that we've produced and put on our website. So feel free to visit there to get more information. And as always, we'd be happy to take a phone call and answer any questions. Thanks again, and have a great rest of your day.